passive equity investing strategy for portfolio management is become more and more popular. Why there are so many passive fund? Well, here we can summarize by five reasons. The first one is because most investors are taxable. Now think about that. If you're using the active fund have to rebalance their portfolio more frequent. All right, more frequent. They have to rebalance maybe every month or every quarter. And some of the passive fund, they usually rebalance once a year. So once you rebalance, then you have to buy, you have to sell, then you will have a lot of realized gain and loss. Especially you have realized gain, and that is taxable. However, the passive equity fund, because it's an infrequent rebalance, therefore the realized gain or loss can be converted to the unrealized gain and loss. So that would reduce their tax exposure. Okay, that's a major advantage. The second is the information disadvantage. For most of the fund managers or individual investors, they don't have enough information about the global market or the sophisticated information about different type of the market. So with that, it's better just don't take advantage of the information bias. Just stick it on the market index. Usually that is the passive investing strategy. All right. Another one is this. This is more important. Is that if you believe that the market, especially the information, all right, it is efficient. Okay, so it's efficient information and efficient market here, capital market. Now, especially in the large cap, like S&P 500 or Nasdaq 100, we know that there's a huge amount the investor are following all those stocks, so the market tend to be efficient. Then this is the case why we want to do the active use for the large cap market. Another one is, well, avoiding this high transaction cost, especially in the small cap market. Okay, small cap market is illiquid, so the trading volume is low, and it's going to involve high transaction cost. Then we don't need to do any active management and especially take advantage of the high return from the small cap, but just go back to the large cap and do the passive investment. Okay, so it is true that the current evidence show that, all right, if you look at the return from the active manager, right, the active management or active manager deduct the transaction costs or fee, all right, actually they did not beat the market. So we're not able to, the active management, unless you are very, very, very sophisticated and high return. Otherwise, you're not going to justify the high cost. Okay, so that's the disadvantage of using the active management. Passive equity investment strategy is the indexing strategy. So that means that we need a benchmark, we need an index. So what are the structure of an index? All right, there are three structures. One of everybody know that it could be a price weighted and or the value weighted. Okay, and also you have another one called equal weighted. So, well, let's think. Let's just go over quickly to review what are the differences of those three different weighted schedule here. The price weighted, in other words, the concept there is that you are actually buying and hold, right? Buying whole one share of each stock in the index component. For example, if you look at the Dow Jones Industrial Average or the Japanese Nikkei 225, the Dow Jones Industrial Average had 30 stocks. So the index actually tracked the price movement of 30 stocks. But holding that you are buying one shares or equal share of each 30 stocks. Okay, so that is called price weight. So because you are buying each one shares, then there's a drawback is the one had a highest price would dominate the index. So for example, one price is $300 and the other is on average around like say $60. That $300 stock, even though it may not be the largest capitalization, but since because $300 such a high price, it's going to influence a huge amount with the index. Therefore, these price weight index can be used for the major market index, which is like Dow Jones Industrial Average. There's 30 stock. Each stock is are the stocks. The 30 stock are pretty much equivalent to each other, and the price are very very similar because they are representing the head of each industry, and therefore you can do it. All right. Otherwise, for other stock like Nasdaq, it's just going to blow it out. Somebody had a highest price, is always will have the biggest influence on the index. Therefore, any firm split, all right, stock splits, right, or repurchase stocks, it's going to affect the price per share, or each dividend, all right, if it's stock dividend, it's going to affect the price. This is going to affect the index. Okay, so the price weighted index is very sensitive to the stock split or repurchase stocks or the stocks or stock dividend. Value weighted index, on the other hand, is much better because it's automatically adjusts for stock split. So it's insensitive to the stock split because, all right, the weighted average is based on the capital size, which means that you own all outstanding share instead of the only one share of each stock. The value weighted is the concept you own the whole market, every share. Okay, every share you have. Every share is tradable in the market. Okay, so therefore that what doesn't matter that because it's all the share times the price is the total value. So it doesn't matter you split the stock because even though the price drop, but the number of shares increase, so it's not going to affect the total value. Okay. So next time the exam said why the stock split is not affect the value weight because what? Because implicitly the index all shares. Okay, all shares. Now the drawback is that because it's on all share, so the company had the highest share and price together, the largest cap, it's going to dominate the market. Right? So larger market cap is going to dominate the market bias. Right? So the index could be overvalued, right? Because it's going to influence by few very 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 large company, right? And then it costs less diversification benefit, so it's less diversified, overweighted by the large cap. This is the problem with the value weighted. Okay, like Nasdaq is controlled weighted by the first 100 company, even though they have a couple thousand firms, but it's dominated by few of them. So that's the bias. Another important thing is that you have to be careful about the value weighted because we assuming that it's supposed to be all outstanding share. However, there's some share it's not floating in the market for trade. Okay, so we need to do this called the flow adjustment. All right, so it's called flow adjustment. Why flow adjustment is needed? Because there are many shares, even though some of the share has a price, but it's not ready for sale. So it's close held share. All right, the close held share by the like treasury stocks. They are part of the share, total of the share outstanding, but it's not actually tradable in the market. And another one is even more dangerous is some of the shares is cross market listing, like the share actually trading in New York at the same time trading in Tokyo or in London. So those cross how a holding share is going to double count of your outstanding shares in your index. Therefore, we need to have adjustment for flow, all right? For those we call the floating share there. Now, most of the value weighted index today are free flow adjustment, so you don't have to worry about that too much. The flow adjustment it's very costly. All right, those value weighted index include like S&P 500 and the CI and so on, Russell 2000, and all those major market index are value weighted index. Now we know that this major problem of the value weighted index is because large cap stocks dominate the index. So to adjust for that, some of the researchers suggest why don't we use, instead of using the capital weight, can we use PE weight, price earning ratio, right? So we adjust by the earning, right? And this maybe is a way to solve this problem. But again, the PE ratio is very dynamic and may not be really robust, all right, to correcting those problems. Okay. Now, equal weight as like a value line composite weight, and there are many different equal weights. Sometimes, like for example, S&P 500 is XPX, but now we have XPAE. That's equal weight or EQ. Equal weight meaning that some amount of money, same amount of money, not the same share. You don't, price weight. You own one share of each stocks. Value weight, you own all share. And then equal weight is different concept, is equally split the total amount of money. Suppose $100, 100 stock, each one get a $1. Okay, so that is just the equal allocation of the money. Say $100 is the base. Invest in the share of each index component, same amount of money. Okay, same amount of money. And what's the problem there, right? Then we got this small company bias, because large company and small company had a same weight. Okay, same weight. But a large company, that means what? The high risk company and the low risk company, they have a same weight. So this could have toward the bias of the small company. Now, if you're using the equal weight index, say, or the market index of S&P, Russell 2000, for example, small company, and you're going to face a problem is that since you're equal weight, and then you equally actually access to a very small stock, and then you're not able to rebalance because it's lacking of the liquidity. Okay, that's the major problem there. It's just too small company have dominated that index. So we know that for rebalance, transaction cost is high, liquidity will be low for the equal weight index.